Deal Flow, the go-to destination for high-level private equity and real estate professionals, including institutional investors and market experts. I talk with industry professionals week on everything real estate. Today we have Chris with us, who's the CEO of CSA Partners with over 20 years of industry experience. He holds an extensive track record in specialty tax services with a focus on real estate and energy. Chris, thank you for joining us today.
Hey, Michael, thank you for having me on. Excited for the conversation.
Yeah, I mean, who isn't excited about to talk about taxes and how you might be able to save taxes if you are a real estate investor and then an energy investor as well. So looking forward to jumping in. Why don't you just give me, I know I gave you a quick bio, but just give me like the 2-minute version of Chris in a nutshell and a little bit about what you guys do over at CSA.
Sure. So CSA Partners, we are, as you mentioned, a specialty tax services firm. We focus on just a very small sliver of the tax code that primarily does focus on real estate investors, specifically around cost segregation, personal property valuation, accelerating depreciation. Our firm, we're just a little under 100 folks based here in Salt Lake City, Utah. We crank out about 5,000 to 6,000 cost segregations a year. The big thing that I'm most proud of is, as a firm, we support a little over 11,000 CPAs across the country to do their cost segregations for them. So they have the harder job. They have to know the whole tax code. We only have to know a portion, but we've gotten really good at that and deploy it across the whole country.
Got it. Okay. And so, wow, 6,000 of these reports every single year. Was that a yearly number?
It was. Yeah. And is. And gosh, every April, it feels like they all happen in one day. But yes,
right, well,
annual number.
Got you a little bit after April, so maybe a little bit going into your slower season in your world.
Yeah, a little bit. It does pick back up in September and October for all the extenders, and as I'm sure we'll dive into, there's a lot of people watching very closely today to see what happens on Capitol Hill, because that's going to dictate a lot of what's going to be going on with activity, transactions, and tax implications. So
sure. Well, before we get into the current events, tell me a little bit about for folks that are listening who maybe don't know what cost segregation is or kind of what it is that you guys do to help folks. Can you just walk through what cost segregation is and some of the terms that you just described to make sure everyone's on the same page?
Yeah, absolutely. So cost segregation's been around for a while, and the reality is that at first it was something that was really only being applied to larger properties and perhaps even new builds. But as the decades progressed, and the IRS had more and more challenges with investors in segregating real property valuation and personal property valuation for the purposes of depreciation, it became something that became available to most people. So most investors have the option for it now. And what it is specifically is, whenever any investor buys a property, one of the biggest things that they have at their disposal with doing that from a tax standpoint is depreciation. So right off the bat, that asset that you buy, if it's a commercial asset, it's given a 39-year life by the IRS. If it is a residential asset, it's given a 27.5-year life. What you have the ability to do without even doing anything fancy yet is divide the value of that property by that useful life to capitalize on that depreciation, which basically acts as a loss when it comes to your taxes, which is a major benefit. It's one of the reasons many people buy real estate to begin with. Well, what cost segregation provided investors is to say, well, that whole property is not one asset. If you start to pull out some of those assets, particularly you eliminate, say, land and structure, roof, things like that, say, okay, those things are part of that whole property. But the carpet, that's not going to last 39 or 27.5 years. The cabinets, the crown molding, millwork, and the way personal property is categorized by the IRS, it's not just those assets, but it's the assets that are put in place that serve as a primary support of those. So think of wiring for lights, for instance. All of those things can be segregated, and your depreciation, accelerated depreciation, or your loss can be pulled forward drastically to now by taking those assets, which are personal property, moving them into buckets of 5-year, 7-year, and 15-year. By doing that and shrinking it from 27.5 or 39, the cash benefit to the investor from their tax standpoint is fairly large. What it means for most investors by doing a cost segregation, depending on the property, is somewhere between 20 to 40% of a deduction that you get right away. And we'll go into bonus depreciation, but bonus depreciation gives you the ability to take that all in the first year. So it's even more compelling. Real estate, as everybody knows who's probably listening, is a present value of cash flows game. This just gives you more, and it gives it to you at the expense of the U.S. government, which I think we're all happy to do. So that's cost seg in a nutshell.
Got it. You also just maybe spend a minute or two on the energy side. I know this most of our audience here is really real estate focused, but just so we can understand a little bit more about stuff outside of our asset class a little, maybe tell me a little bit about how the energy side works and maybe how it's different from the real estate side.
Yeah, well, so and on the energy side, it has a unique implication with real estate. And what's happened is over the last couple of years, especially with the Inflation Reduction Act, energy has crept in more and more to real estate, but it's a specific type of real estate. It's primarily reserved for new construction. As you probably recall from the election season, there was a lot of campaign speeches about providing housing. And so when you look at tax credits and deductions, they're all typically centered around that new construction. So what happened was energy got layered over those. So with that, for commercial properties, the thing that we focus on is something called 179D. It's not the same as a 179 deduction, which is often confused for. 179D is the IRS does that. They throw out numbers and letters and they just say, you figure it out and make sure you pay everything correctly. But 179D is for primarily new construction, and if it meets a certain energy threshold. Now, the good news is that most new construction on the commercial side, the building code in the local jurisdictions has caught up to the federal. So if it's being built according to code, it's probably meeting the energy requirements, and you get roughly $1.20 per square foot deduction for that. If you pay prevailing wages and apprenticeship per the Inflation Reduction Act, you get up to $565 a square foot in 2024 and $585 a square foot in 2024. Those are deductions you get to take in tandem with the cost segregation if you're meeting the energy component. And the other one's the 45L tax credit. That's for residential, so it could be for single family homes and for multifamily, and it's a per door credit. So it's pretty compelling. Challenges: Inflation Reduction Act made it very challenging to get because you have to meet certain Energy Star criteria, pay prevailing wages depending on the property. That's what we do. We are kind of watching to see what happens right now because at least a pay for in the new bill, so something they want to eliminate to pay for extension of cuts, to provide bonus depreciation, and many other things that are in the bill. They might get rid of a lot of these energy things. So they could be out there, but we're waiting to see what happens. So if you are in that category where you are building and you're expecting those, it might be shaken up. But if it doesn't and you weren't expecting them, it might be a good surprise.
Yeah. Well, it's it's late in May of 2025 for those who are watching this. Once it gets released, I'm sure some of this has been settled by the time it does go into production. So we'll know more then by the time people are actually listening. So yeah. So you said 20 to 40%, which in the real estate game we're levered usually 4 to 1. Mm-hmm. So it sounds like in some cases, or you're basically able to offset almost your entire equity check with tax savings. Or am I misunderstanding that, or is that sound right to you? Or
no, that's spot on. And the 20, I throw that in there for conservative sake because it's those lower amounts typically come in with buildings that don't have a lot of improvements. So think of like a warehouse or self-storage if some of your investors are work in those types of properties. But anytime you have something with a lot of improvements, you're typically north of 30. So yes, you are looking at it right. If it's a $10 million basis, then you're probably, and if it's a multifamily or if it's something else, it's not a warehouse or self-storage or cabins. Cabins are awful. There's probably about $3 million in deduction to go get. So it might not be direct quarter because that deduction, you apply the tax rate to figure out what your tax savings are.
Right. It's not a credit. It's not a credit. It's a deduction. So it's and presuming that a lot of your investors are at the top marginal rate. Maybe they exist inside of California, New York, et cetera. They're paying upwards of 50% taxes. 40-something% taxes. So in those cases, that $3 million is really 1 point something tax savings.
And you could offset the equity element, but or help wash that a little bit from what you had to put forward. But it can help with making improvements and doing the thing. Or if you're buying a portfolio, doing a cost segregation and timing it the right way around the filing deadline will give you cash to use to leverage and buy another property, and then do the same thing and continue to repeat it. So without, typically the calculation goes into for an investor, like you're just saying, Michael, is all right, what's my equity? What I'm going to leverage? What's my buying power? I find that with cost segregation, even if they've done it, they've typically done it after the fact and didn't plan accordingly. If you plan based on the fact knowing you could do that, you get to extend your leverage with essentially a 0% loan from the government. There is and I would say within real estate, that's the thing that's surprising to me. It's so often underutilized. And this can even be the planning stages. This can be done even before you've broken ground or even before you bought a property. If you know what it is, if you know what you're going to be paying for it, you can start to figure out what the true taxes are going to be on it versus just assuming taking straight line depreciation. And that's where I think investors typically have the largest opportunity, because they can plan better and they can make more acquisitions.
Mm-hmm. Yeah. And so that kind of like lays the groundwork for what it is and why it's beneficial for investors to be doing this. Are there any circumstances where this in real estate, this you wouldn't do this, or that you wouldn't take advantage of the tax deductions here, or just making sure that there's no educations here, or if there are listeners who are in deals and they have their operators or themselves, or they're working with operators and they've invested as an LP, are there any circumstances where they would ask their sponsor, hey, have you guys done a cost segregation? Have you taken advantage of the tax code? And they said no. Is there a good reason why that would be the case?
So there's two things to consider to start, and then I'll give you the third thing, especially if you're talking to a sponsor. The first two things is there's something that IRS calls a real estate professional, and it's real estate professional status. It's written in the IRS tax code. If you are a real estate professional, then you're basically saying that you're dedicated. Your job is a real estate professional. You can't be a sales executive for a technology firm and then own real estate and say, no, I'm a real estate professional. They're going to call you out on that. So proving that out is number one, because by being a real estate professional, it lets you offset the income associated with being a real estate professional. If you are not a real estate professional, then you need to have passive income to offset this deduction. So that would be the sales executive who works for an entity that's completely unrelated to real estate in any way whatsoever, and they're buying Airbnbs. The income they're getting from the Airbnb is passive income that could be used to be offset by the cost segregation. So if you have a property but you don't have any income, a cost segregation is just a really expensive report that you can't apply to any income to offset. So those are the two things that I would say, all right, if you meet one of those two criteria, then you have earnings that you could take and then remove the deduction. But the third one is, and I find there's kind of like a boogeyman in cost segregation, is the term recapture. So what recapture is any depreciation that you've taken, even if you didn't do a cost segregation, when you sell that property, the federal government says, okay, you took that depreciation, you took that loss, that expense, but when you sell, you're giving that back. And that just terrifies people. I don't know why, because if I told you, okay, I'll give you $1 million now, I'm not going to charge you for it. You just got to give me $1 million back in 4 years. I'd be like, okay, that seems like a pretty good deal for me. So that leads into the next question of, okay, when does it make sense, given that recapture is out there and I had to give some of this money back, I got to give the principal back, it really is the present value of cash flows formula. So what I hear when people go to their sponsor, they say, hey, have you done a cost segregation? I've heard people say, well, no, I'm only going to hold it for, say, 2 years or maybe even a year and a day. And I would still push back on them a little bit, because cost segregations, they're cheap. I mean, I'd like to charge more as the person who runs a business, but there's IRS circulars that don't allow you to do that. So it's relatively cheap. So what I would encourage anybody, if they're asking that question and they get that response back, I would just look at what is the fee to do this service, which it does require somebody to go walk the site for a pretty complex property. If it's not complex, somebody can do it remotely. But look at what the benefit is and see what having that cash for a year would do to you, and see what the net output would be, even if you threw it into a CD at 4.5% or 5%. I mean, very quickly you could say, all right, well, that makes a lot of financial sense. I don't know why I wouldn't be doing that. And then there's also, the thing that's not talked about very much, because it's a little bit more challenging, is when you sell the property, there is actually opportunity for you to avoid a component of recapture, even if you only had it for a year. Stay with me here. But what happens is when you do a cost segregation, you're separating out two pieces of property. Think of it as real property structure and personal property. If you hold that property for 2, 3, 4, 5 years, the value of the property has gone up, but you know what has not gone up is the carpet or the cabinets built specifically for that property. Those, when segregated, are specific assets, and those are now at a market value according to a third party, not nearly what they were worth when you bought the property. The land has gone up and the structure has gone up, but not these pieces. So one of the things that we do to help our clients mitigate recapture and not have the same exposure to it is shift those assets that have basically lived their life or only are percent good now and move those back to the land. By doing that, you increase your capital gain because it reduces the basis, which is a 20% tax rate, but it eliminates recapture for those assets. That preserves and locks in the savings for the borrowed money that you got from the federal government. So there's typically a lot of things that could be done, but that's one where that's a little bit more challenging. And knowing how to value 5-year-old carpet, that's not an easy thing that everybody has in their back pocket, and that fortunately we do. But also categorizing all is not easy either.
Mm-hmm. Yeah, and I presume also you can avoid recapture by just 1031ing that asset into the next one, can't you?
You can 1031 this thing for the rest of your life. Just keep kicking the can down the road. Absolutely.
Yeah. Okay. So it's the recapture is really an issue in the event that you're going to liquidate the asset and you're realizing a cash event liquidity. But if you're not going to realize that liquidity and you're going to move that to the next property, then we can just keep on rolling at that point, and we can do cost segregation again.
You certainly can.
Yeah. Yep. Okay. And so you had already talked a little bit or previewed a little bit about what's going on today and maybe how some of these things might change in the future. I know some of this is in the air, and maybe there's going to be, by the time this airs, there'll be some resolution on some of this, but this stuff is changing all the time. Every administration, every time a budget comes out, there's always whispers of changes to the bonus depreciation, the real estate professional status, the, blah, 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 blah. So what is currently like the hot button? What are you guys thinking about or seeing right now legislatively that may affect some of your business and how we operate as real estate professionals and utilize the tax code?
Sure. Well, whether you're red or blue, you can definitely acknowledge that things are changing really, really fast each day. So there's a better than zero chance that even tomorrow this conversation might be dated because of what's happening. But what we're seeing a priority for bonus depreciation. So again, take all those benefits, 5, 7, 15 years, just moving them all to the front. That's what bonus depreciation is. They could take a benefit that, is $50,000 then turn it to $120,000 benefit just by bonus depreciation. The reason that one seems to be prioritized is getting the least amount of feedback. It's also was mentioned in the address to Congress at the end of the year, in March. So that one seems to be right there. It's of course a big one we're looking at because to look at it and say, all right, what's going to happen? What's going to impact real estate? A lot of things are obviously, making the market a little soft right now when it comes to real estate. Interest rates are a big piece, but also the effect of having bonus for 4 years. I mean, we were essentially mainlining bonus into the market and said, you only get it for these 4 years. So people were scrambling, they were trying to get as much as they could during that time. We said, then we're going to phase it out. So we basically kept making our sale not as good. We're like, it's half off. Now it's a third off. Now it's a quarter off. And so we're at the end of that right now. So we're at the end of what was a sale. So everybody jammed in their transactions to get bonus. And now they know that, well, one's coming. So we're in between a sale going away and a sale coming back. So that's causing a lot of, a lot of wait and see from what I can see in the market to see what happens. Now, in the address to Congress, and it sounds like in the bill, everything will be retroactive for January of 2025. It won't go back before that because it's too hard to update software for all the CPAs. But it will be retroactive for this year. So I think that's a hold right now for a lot of folks. With that bill, it seems like the news I was listening to this morning. Obviously, I'm paying very close attention to it. Was there's like 3 or 4 votes that are just kind of needed to get over the hump, and there's a couple of other tax elements out there that you may or may not be familiar with, but they would impact investors. Is the SALT exemption. for income, property, all the things that you're exposed to in your particular state. And there was some Medicaid elements around work requirements. So these are the things that are the hangups right now that they're trying to get past. But that bonus depreciation piece, and we're seeing everybody's asking about it now. From our end, what we're doing, because we're always asked about it. Right now, you can only get 40% bonus this year. What we're saying is we're expecting there to be, if this passes, a pretty big surge on demand. And if you're familiar with the tax and accounting space, the CPA space, there's just not nearly enough people majoring in that and going into that career path. It's a real problem that those firms are trying to figure out. It's even more pronounced, I would say, in cost segregation, because you have to have tax knowledge and construction knowledge. Usually those two worlds never intersect. So point being is that you still need the people to do those site visits. You need the people to prepare the reports. So we're going back, we're getting the site visit done, categorizing the assets. If bonus passes, we can simply redo the report. So I tell people is if you're thinking about buying property, you've already bought a property, go ahead and take care of this if you can, because at the end of the year, next March, April, you're going to be dealing with a bottleneck, probably to the likes which we saw in 2018 and probably in 2021 after COVID when bonus was still live.
Got it. Okay. So but it sounds like most of those things are net positives.
I think, yeah, I'm going to love there being a bottleneck. Yeah, for sure.
It's about increasing the SALT deduction. It's about adding bonus depreciation back to the old world where it was 100%. So this is well, we'll see what happens, right? Because they may not go through, but there's a bit of a horse trading, I'm sure, going on here.
And there's a lot of political grandstanding, it seems like, too. Like somebody wants to know, hey, I held out for this or I held out for this, but the key teller is the market. It seems to be priced in. And if this bill was not passing, I think we'd see we'd probably see a halt in trading because the market would tank so bad. So it's still holding right now, but we'll see where that goes.
Okay. And, I guess what else is interesting from your perspective? I mean, what are you keeping an eye out for from a tax perspective, or should investors be thinking about when we think about, taxes? It sounds like preventative, kind of getting ahead of it, planning in advance of acquisitions, things like that are how you can be best positioned to take advantage of these tax benefits. But is there anything else that maybe people, should be aware of as real estate investors from a tax perspective that maybe we haven't covered so far?
Yeah, one of them would be is a big one that's obviously sometimes misunderstood is cost segregations are a lot like I'm sorry's. It's never too late to say it. And if you did an acquisition years ago and didn't do one, it doesn't mean the boat has been missed entirely. So yes, it would be ideal to plan even pre-acquisition to get understanding for that. So for those of you who have purchased something, it's been 5-6 years, it does not mean that you can't go back and still get the benefit of that. And even for those of you who purchased things between 2017 and 2022, you still get 100% bonus for those properties that were acquired. So if you're sitting there saying, dang it, I missed it. No, you didn't. And actually, it's not even that big of a deal. The IRS expects this, so you don't even have to amend your return. There's an easy form to fill out, 2 of them. We provide that, and that's what we're seeing a lot right now. That somebody may have bought 60 homes in a single portfolio, and I go, yeah, I never did a single one, but I bought them in 2017. It's too late. No, it's not. There's something called catch-up depreciation, and then you can just simply change the method of depreciation you're taking. And your accountant's not going to charge you a whole bunch of hours to do that. It's only going to take them another hour or so, and you might get a massive cash benefit. That's one. And for those of your investors who are doing things like renovations, they're buying a home and adding property to that, or doing improvements after that. There's 2 things that are often overlooked or overlooked or just applied incorrectly. That's something called qualified investment properties. QIP is the term for it. So those are assets that, when improved after the building's already been in service, then you bought it, and so then you maybe add a whole bunch of other new things to this property. Those are all bonus eligible right away if they qualify for that QIP standard. But the other thing is that I would say is overlooked 99% of the time. And to think about is if you are replacing something, so say it's a roof. A roof is not something you could accelerate depreciation on. But if you buy a new roof, in a depreciation schedule, without boring you with the tax, how it works in a day-to-day tax situation, is you have a table of depreciation which has each asset and it has the year's life of that asset. When you buy a property, let's just say it's an apartment, it would just say one line apartment, $1 million. Your old roof is in that $1 million. When you buy a new roof and it says new roof underneath it, the old roof needs to be valued and pulled out for whatever a value of a 5-7-year-old, and it's completely expensed. Those are things we didn't discuss, but those are the two. It happened years ago, or if I've done this renovation type of project, those are typically, I might not go do a cost seg because I think I missed the boat, or I do a renovation. I don't realize that I'm paying tax for 2 roofs. That typically needs to be looked at in detail and be thought about. And if you have questions on it, we're your people to talk to.
Got it. Okay. Well, I guess that was sort of the hey, give me the stuff that we didn't talk about question. But I would just, with time that since we're wrapping up here, is there any last golden nuggets that maybe we haven't? And I know you just gave a couple right there, but I'm going to try to squeeze one more out of you.
Yeah.
Anything else from a tax perspective or otherwise that you're hearing from your clients or that you're doing with your clients that, again, may not be commonplace, but might be something that listeners might want to know about?
Sure. Well, I think it's appropriate to really finish off on risk mitigation, because when it comes to taxes, I think after people have seen stuff like ERTC, and I get calls every day saying there's tax savings out there, and without just sounding like another one of those people who say I have tax savings for you, I think the question should always be asked by every investor: you're giving me savings at what cost? Are you exposing me to more risk? Is it going to be due later? All of those things. And what I will say in the cost segregation world, if you're thinking about looking into this, you've never done it before, or you have, and you're trying to find the person to take it to do it for you, is this business has just fragmented like crazy. People see opportunity, and now you have things where you can do it yourself. You also have these things that are completely remote. And what I will say is the IRS has a very specific guideline for what will hold up in an audit. And sometimes, especially for real estate investors here, you've done your own DIY projects in your home, and then you have to call a contractor to come out and fix it. And so you end up having to pay a little bit extra as a result. Within cost segregation, there's 6 methods, and the top 2 are engineered. We pretty much only stick to engineered. And what I will say is, even though we've seen the IRS be doged pretty heavily, we've seen about half of our audits just get slashed and they're gone that we were supporting. But you had a pretty low, very minimum, small. What's the word? You had people with very little tenure at the IRS who were doing these audits, and if you make their job too easy, they're going to take advantage of that. And what I've seen a lot is land value. Land cannot be depreciated. And when you do it yourself, it's typically the hardest thing to do. And the thing's going to make your CPA the most mad too, because they have to go undo everything. So before getting excited about savings and finding somebody who's going to do it for $500, I would just ask the question: are you reputable? What type of study is it? If I get audited, what will happen, and what will you stand behind? Savings are not worth a darn thing if you can't answer those questions. So go after them, but also avoid the IRS, even if it's being cut. They take their job seriously.
Yeah, and you never know when that head count will go back up, right? So things change, and the tax, they can come after you for forever, basically. So I think things, it works both ways, right? You can take advantage of the tax code from the past, but they can also come back, to bite you if you don't do the right thing. So, Chris, thank you so much for your time and for sharing some great insight and knowledge within the real estate tax space. If our listeners wanted to get in touch or find out more about you or your firm, what would be the best way for them to do that?
Yeah, so we're CSAP.com, so CSA Partners, CSAP.com. And you can go there. You can, feel free to reach out to me directly. I'm just Chris, CHRIS, at CSAP.com. But I know people want to go do their own go do their own investigation, so I encourage you to do that. But if you have any questions or have used somebody else, want us to take a look at it, make sure you're protected, see if there's any other dry powder out there for you to go get. Or if you're about to sell something, usually your cost seg person doesn't say, I have something for you. I do. Feel free to reach out.
Okay, well, there you go. Well, great. Thank you for tuning into this episode of Deal Flow. Don't forget to give this podcast a follow on Apple Music and Spotify, and subscribe on YouTube so you don't miss an episode. Thanks again for me, and we'll see you on the next episode of Deal Flow. Thank you for listening to Deal Flow with me, Michael Pulio. We hope you gained valuable insights into private equity real estate and market trends. Stay tuned for more expert discussions and updates on the latest in commercial real estate and structured finance. Don't forget to subscribe, rate, and review on your favorite podcasting platform. Join us next time for more high-level conversations that empower your investment decisions and your operating results.